Dear students, the topic of today's video lecture is mergers and acquisitions. Corporations, as for-profit organizations, strive to optimize their business performance over time and increase return on invested capital. Corporate managers achieve this by employing two core growth strategies. Organic growth strategy, which usually implies improving the cost basis while maintaining the sales volume constant, or vice versa, improving the sales volume while maintaining the cost basis constant. And M&A strategies, also known as external growth strategies, which imply a merger or an acquisition with another company with the objective of forming a business entity which has enhanced economics of production. In other words, a business entity which can capitalize on certain synergies arising from the particular business combination. We have a number of different types of mergers and acquisitions, horizontal mergers and acquisitions, which are usually relating to companies from the same sector, competitors. Vertical mergers and acquisitions, which usually relate to companies from the same supply chain, so a supplier and a client. And conglomerate mergers and acquisitions, which are companies usually involving companies from different sectors, as a result, non-related businesses. Now let's talk about mergers in a bit more detail. Let's take two companies, Company A and Company B, which are from the same sector and of relatively the same size. The management of Company A and the management of Company B agree to merge their two companies with the objective of forming Company AB. This new entity, Company AB, will become the aggregator of all the assets and liabilities of the two separate companies A and B. As a result, the shareholders of Company A and the shareholders of Company B will own shares in the resulting entity, Company AB, and their shareholding will be proportional to the shares they owned in their respective company and the valuation at which the deal was done. One should note that mergers may result in the shareholders of Company A, for example, owning more shares in the resulting Company AB than the shareholders of Company B. And this is primarily due to the different valuation of the companies. If Company A has a higher valuation than Company B, then its shareholders will own more shares in the resulting entity. In the case of acquisitions, again, we have two companies, Company A and Company B. Company A decides to take a controlling stake or acquire, say, 100% in the shares of Company B, and as a result, integrated in its corporate structure entirely, either as a subsidiary or as a standalone entity under the same holding structure. And in this case, the shareholders of the selling entity, Company B, will have zero economic interest in the resulting business entity, which is Company A. To repeat, in the case of a merger, we have the formation of a new business entity, which is formed by the constituent assets and equity of two separate businesses, Company A and Company B. In the case of an acquisition, we have a case whereby one company acquires another and integrates it into its corporate structure. Now let's have a look at why companies engage in M&A transactions. Generally speaking, corporate managers would engage in an M&A transaction if this transaction has a positive net present value. In other words, if the outflows of cash are lower than the implied cash inflows. Business managers engage in an M&A transaction when they want to enhance or unlock the value of their business. And this value is expressed in the form of operating and financial synergies, new growth prospects, either within new product markets or new geographic markets, increasing the market power of the business in the segment it occupies, acquiring unique capabilities either domestically or abroad, achieving economies of scale and scope, and acquiring additional debt capacity, and ultimately improving the overall cost of capital of the business. Business managers would engage in an M&A transaction also when they would like to internationalize their business. This internationalization is expressed in technology transfer, either inbound or outbound, capitalizing on market imperfections in certain, for example, developing economies, regulatory arbitrage, which implies avoiding highly regulated markets and deploying business operations in less regulated markets, product differentiation, and also cases where a business manager decides to explore a new geographic market because one of the major clients of the company has entered this market previously. There are also other reasons why companies engage in M&A transactions, and these relate to the personal character of the business managers and their ego and desire to pursue big transactions. Such reasons also relate to trying to capitalize on certain tax benefits which may result as a result of the business combination. Also, general business diversification and ability to minimize the operating and general business risks of the enterprise. Now, let's have a look at what motivates sellers to engage in an M&A transaction. When we talk about sellers, we will talk about a company which gives large part or all of its equity to another company. For example, company A acquiring a majority stake in company B. Company B is a seller and company A is the buyer. And what motivates company B to engage in this transaction? Well, there are a number of reasons. One such reason is business continuity. If it's a family-owned business and the management is reaching, for example, a retirement age and would like to ensure that the company will continue to survive after the retirement, it is normal for the business owner to welcome bids from interested parties. Another reason for a seller to engage in a transaction is to capitalize on current market conditions. If the valuations are high and the business manager considers that he could get a significant premium for his business, then he's likely to welcome bids from other companies. Another reason, which is one of the key strategic reasons for participating in an M&A transaction, is a bid from a strategic buyer who could help further grow the business, who could help the business enter new product markets, new geographic markets, build a strategic scale within the niche it occupies, and ultimately make the business more sustainable in the long run. And finally, another reason for engaging in an M&A transaction is the need for cash. When the business owner is in the need of cash, he is more likely to engage in a business combination. Now let's talk about synergies. As we mentioned, one of the primary reasons why business managers engage in an M&A transaction is the ability and the expectation to capitalize on certain synergies. Now, what is a synergy? A synergy is a benefit arising from the strategic management of assets and resources in the post-M&A business entity. Synergies could be commercial in nature, and opportunity areas for business managers involve cross-selling, the opportunity to share product development and innovation, the opportunity to further enhance the brand portfolio value, leveraging on sales capabilities, and ultimately expanding the sales network and the ability to penetrate the target markets. Synergies could also have an operational nature. This evolves primarily around the sharing of back office functions such as IT, finance, human resources, the sharing of procurement systems and supply channels, but also the further utilization of production capacity and facilities. Synergies could also have a financial nature, and this is expressed primarily in the ability to further improve and optimize the capital structure of the post-M&A entity, the acquisition of debt capacity and thus the reduction of weighted average cost of capital, and also the improvement of credit rating and general financial stability of the business.